Hi, Warriors. Hope everyone had a good weekend locked inside their cell. Hope everyone has a nice warden. Make some chicken soup and nice meals and everything. Everyone ready to rock? Who's ready to rock? Give me a Y. I'm ready to rock at 5 a.m. Anyway, all right. Enough of this. Okay, so Charles is ready. Look at these. Look at these warriors. Ready to step into the arena and do battle with the algos of death. All right. So I'm going to start off with crude here. And I was watching this last night and I was looking for a 3. All right, we only got a 2. Everyone see this in WTI? All right, so this is the reason when I talk about the second drive being a reason to cover, because if you had covered it, and what's not ideal about this RSI reading? Anyone know? Another reason besides waiting for a 3 why I didn't participate here? Any guesses? Payment's got it. Okay, that's right, payment. All right, so here we're pulling back into this zone. If I move it out to a 1 hour, it still could be possible, but this could be it right here. We're just pulling back right here because if I draw a 3 drive line on crude, it's going to be pretty deep, right? It's going to be a little deeper than I would, it's going to be almost at new lows down here for a third drive. So, we could get this on the 1 hour. You could see that, we did hold 30. I'm tempted to go now, but I think I'll wait for a turnaround Tuesday. I still think that there's potential for a pop here, all the way to, where did I have this? 36, 38. Let me just, so I'm stalking crude. I'm not long yet. I think I could forget this. And looking for a continuation bear market rally here. Of course, at new lows, I'd be gone, but I'm looking for a place to buy it for the possibility that, we could have something like this from here that could take you up to, 36. I mean, there's a huge gap up here, right? This gap, see this? So I'm looking for some action into the gap on that. Okay. And I don't think that the S&Ps have peaked either. Here's a key candle to watch, and it happened last night. S&Ps opened up here and sold off, I don't know, about 60 handles. So this is what I'd call a key range candle here. And if we you just measure, it's almost 100. It's 97 from high to low. So we take out the low, it's going to give you 27.25. Excuse me, 26.25, which is going to be, right around here, the 38% level. And we take it out, it's going to give you around 29.25, which coincidentally is about 61.8 up here. I'm still waiting, still think there's a chance for 61.8 into next week. I'm thinking, what could be the catalyst besides just technicals? And I think what it could be is an extension of the U.S. national guidelines for at least another month into June. Okay, so I think that might be the catalyst for the sell-off, for a retest of the low, or a retracement of this or even a new low. So I would say that would take us into next week, is where I'm looking for shorting opportunities in time. I think could be sometime next week. Your first warning signal that it's starting would be action back under this 200 at 2,700. All right, then you have 2640. So far, look, it's held every fib. It's been very methodical. You know, we broke out over the rising wedge, and then we held the 23% at 24. And then we rallied past the 38 and held the 38, and then we rallied to halfway, and we're pulling back from halfway. So really, one way to know technically that things are changing would be for it to take out a previous fib level. Right here is your first one. And then if we move up to 61.8, then it'll be back under the 50%. Everyone with me? Dollar, I don't know what to do right in here. I still say that the path of least resistance is down. I don't like to fade the dollar when euro, although it's not doing anything real wrong, is weaker than cable. So that's what's going on here. Yen looks real weak, but you know, we're at a retracement here. I thought I'd have a chance to sell it up here around at the 61.8. Still could happen if we dig in our heels here, but acting pretty heavy. And Aussie about to get to 61.8 back here. So Aussie's really ripped. What a great trade. 55 in how many? In 2 weeks? 1,000 pips. Some articles suggest the bear run is superseded by bear and liquidity might turn weak. Your thoughts? Okay, well, anyway, Niraj, those are my thoughts in the S&Ps. And let's take a quick look at the gold. So gold hasn't quite taken out the high of the move, but I just want to point out one thing, okay? Don't hang me, but at new highs in the gold, and I want to look at some of Steve's numbers, pretty glaring divergence. I don't even have to put my cursor on it. But this will be the first time, although this was a divergence, it was way over 70 up here. Here it was under 70 at here. And now here we are pressing the highs, and RSI is 63. Okay. And those are my thoughts. So nothing I want to do right now, right this second. I've learned that it's okay to do nothing. I don't know if you have. It took me a long time. I still feel a bit of discomfort when I don't, when I'm, you know, kind of scanning around looking for things to do. When you find yourself looking for things to do, most likely, well, you're either missing it or there isn't. And then what I do, just to check myself out, and that can change, is I'll go to our website and see that we have just one active pattern in play. So, you know, I respect all the guys on the team, right? So if they're only seeing, and it's not like they're risk averse, but if they're only seeing enough to have one active pattern in play, there must not be that much besides little scalps around, because you know, these have to meet certain criteria, 3-to-1 profit risk ratio, etc., for us to maintain our track record and returns. So tells me I'm not crazy or I'm not inadequate. If guys like Greg and Blake and Steve and Stelios and Andre only have one active pattern in play. But I'll tell you something, that could change in 24 hours, and all of a sudden there could be 5 active pips going on. So it's okay to do nothing when you don't know. So Before I turn it over to Blake, this will be cathartic for everyone. Say this: I was wrong, and I don't know. Then breathe out. I was wrong, and I don't know. Or, if you haven't been wrong, just say, I don't know. It's okay. When there's something to do, I'll recognize it. Okay? Instead of going, oh, yeah, I am. You know that, Ziggy. You visited me at that after I had my last nervous breakdown. Anyway, so Blake, how was your weekend, buddy? Someone sent me a video of Richard Gere, and I forgot the movie he was in where he was trying to become a Navy SEAL, I think, and they were letting him go, and he was screaming, I have nowhere else to go. I have nowhere else to go.
Oh,
That's an officer and gentleman, right?
Yeah, oh, that's it. Yeah, Stel.
Yeah.
So I had a Richard Gere attack a few times this weekend. How about you?
Good morning, Dale. Good morning, Stelios.
Hey, buddy.
Yeah, it's been, it was a nice, restful weekend for us. As it probably was hopefully for all of you guys,
for the whole world.
Well, there are some people that are obviously affected by, more so than others by the coronavirus. But for those of us that remain, at home and,
healthy
and remaining home and healthy, it's probably been a pretty quiet holiday. We managed to have a meeting with our family, which was kind of nice, being able to just see everybody's faces, who we normally see on for us on Easter Sunday. It was a really nice it was a nice time, and everybody made their own meals and met up online, and I mean, that's just the way we do things this year, and hopefully next year is going to be a little different. So, but overall,
try and feed anyone on through Zoom, like put a piece of ham against your screen or anything?
No, but I think some people were a little jealous of my wife's quiche. Yeah. I actually had to go to the store and get leeks, which I never do.
so you didn't even know what they look like, did you?
No, I didn't.
I was like, somebody.
No, I was like, what? Wait, what do I got to get? I got to get leeks. And so I, but it was it was a nice time. And it's been a very slow market. Today it's Easter Monday, it's a European holiday. So the markets have been really quiet. Like we did get, like, in the euro dollar, we got a little bit of a move, and people were, I guess in the chat room a little earlier before I got up, like, what happened to the euro? Well, I mean, if you look at what had happened is this, we did a little false breakout, then we did a little false breakdown, and, I mean, the euro is just kind of bouncing around. I'm not super excited about, trading at this moment, and I think I'm going to be pretty quiet today, because I think that volatility is going to be somewhat suppressed. But remember, North American traders are back, so we might have a little bit of liquidity come in. But if you look at the euro, this is something that I talked about over the week ahead video, and I am looking. Sorry, I didn't mean to yawn on you guys. I'm looking at something like this. As a potential, up to somewhere in this neighborhood. If the euro can take off, we have to break. We broke the 50% retracement very briefly overnight. Like I said, I think this is more of a stop run. But really, in order to get the euro dollar going, you got to get it back above 110. But I think it's doable. It really depends on what the euro group agrees to. Right now, it seems like it's the same thing that I talked about over the weekend, is that the Eurogroup meeting, they're just Italy's having a little bit of a tough time because they want more assurances. But the thing is that we are looking at, we're looking at some continued dollar weakness, especially if equities move higher. But one of the things that I think I mentioned it on this webinar, but I want to make sure that I mention it now, is a lot of people are looking at the CME data and and the the futures data and saying, oh, here's the there's a lot of traders that are long or short, the euro dollar or the dollar or some of these currencies. But I had a conversation last week with a guy that probably literally one of the smartest market guys that I've ever met. Super intelligent. He's a little younger than me. Very, very well educated. Worked for Lehman, then worked for, I'm trying to remember what Japanese bank, and then now he trades independently for our firm. Just a super intelligent guy. He's like, I don't look at the COT report anymore. He goes, I think there's so many different transmissions that traders take nowadays that the COT report is not very valuable. Because I was explaining to him, like, I'm looking at the euro and I'm looking at it possible long, but the thing that I fear most at this moment is that there's so many speculators that are long euros. He's like, well, you're only looking at the CME data. He's like, there's really a lot of different transmissions nowadays. And he goes, I don't think that's necessarily representative of what's happening in the market, especially right now, with all the liquidity measures that have happened. And I have to take into account what the Fed has done and the actions that they've done in the last over the last couple of months to really weaken the dollar. So I look at the euro dollar technically, and the way I'm looking at it right now is, while we're above this trend line here, which roughly comes in around 108.50 now, as long as we're above this trend line, I can't really be bearish the euro. Now, you'll notice that what we did today is we came down and retested this trend line, but this is a very illiquid market. It's over a holiday, so I don't want to get excited about, oh wow, look, we bounced right off of there. I'm not feeling that at all. What I'd like to see is the euro push higher above today's highs, more importantly, like above 110, and get a foothold above there. Then at that point in time, I'm going to be really looking at the euro as being a long side candidate and looking for much higher prices. And so that's what I'm looking at with the euro today. Now, as Dale pointed out, the S&P is down a little bit. We're actually recovering as we come into North American trade. You can see the S&P has come off the lows. I do think that we have the potential for the S&P to continue higher. I know I mentioned this during the week ahead video that we have this, AB equals CD move. I think everybody's looking towards 2,900. And as I mentioned during the week ahead video, that I think that the risk is that we don't quite reach these levels because everybody's looking at it. We are struggling with the 50% retracement. I think this area from 2850 to 2930 is going to be where we're headed. I think somewhere up there. But again, I think everybody's looking at the same charts that we are. So when everybody's looking at the same charts and same levels that we are, the risk is that we can't quite make it there. And so, I'll be looking at, just above 28, this 2820 in the S&P. If we can get just above there, maybe to 2850, looking for some sort of reversal for the S&P going into this week. The stock market is going to start to struggle as we come to grips with the idea of, as Dale pointed out just a moment ago, that being able to restart this economy, and the market is really banking on the idea that we're going to be restarting this economy, at least in part, by probably May 1st. But in all actuality, I think it's going to be a lot more difficult for a lot of the economy to open back up, especially when you take into account that, our kids at least in the United States, they are not going back to school this year, not in any, in any, physical way. They may be doing Zoom meetings and being at home, but, there's a lot of parents that are not going to be able to leave their house because of their children. Now, a lot of them are working from home, and I think what a lot of employers are finding out is that that their companies, for the most part, can function pretty normally, even when a majority of their employees are working from home. But there are going to be certain parts of the economy that can't really get started. I think about a lot of we are a services based economy. We are in the United States, and there, whether you're talking about restaurants or whether you're talking about your barbers or your estheticians or people that work in retail, those places are probably going to remain closed for a little bit longer than the market is anticipating. And so I'm trying to be hopeful, but when it comes to the economy, I'm more hopeful about the virus moving forward. I'm not as hopeful about the economy restarting as quickly as the market is, and I think that's where the disconnect might actually come. Now, as far as looking at like the equities and trying to stay bullish in this correction, I think while we're above this support level here in the S&P, I think this is where the rubber meets the road, is somewhere around this 2620 level, and it's an upward sloping or an ascending channel, if you will. So while we're above this channel trend line, I think it's okay to be playing on the long side. We get back below that, and then you're going to have to be a little bit more careful about being long, if you will. Looking at some of the other currencies really quick, cable is challenging that 618 retracement, as Dale pointed out a little bit earlier. I am still looking for the Aussie to reach a little further towards 64 cents. We're getting there. That's a big confluence of resistance up there. The Kiwi is also struggling here at these recent highs in this 618 retracement. The dollar Canadian is, this is really interesting. Crude oil, and as you guys know, all the major news over the weekend was crude and the OPEC meeting. It looks like OPEC's going to cut by close to 10 million barrels a day. That's a big cut, but that was also expected. And it's actually a little slightly lower than expected. And so if you're wondering why crude oil isn't stronger, it's because the cuts came in, as expected, a little slightly worse than expected. Slightly, when I say slightly, it's barely. But if crude can bounce, that might be the catalyst that drives the dollar Canadian through this support. But as you can see, we have currently a wedge pattern, and now we're in a descending channel, but currently there's a wedge. You can see the lower highs, consistent lows. So there is a higher probability of us breaking lower. However, a break above, this 141 would be quite bullish for the dollar Canadian. I would personally, I'd just be waiting for a breakout here versus trying to figure out which direction it's going to break out. You kind of want to let the market, make that decision for you. And this is not the type of market where you want to really be anticipating a whole lot. So one of the last things I want to talk about is the dollar yen. Dollar yen has been pretty weak, and you guys have heard me say this last week. The fact that the dollar yen could not break above 109.30 is really quite frightening if you were long the dollar yen. You have to imagine the recovery that the stock market has seen. Most people accompany stock market strength with yen weakness. And that's been not happening. This last leg of this, well, this current leg, I guess you can say, of the equity market rally has not translated into yen weakness. So I think the risk for the dollar yen is a lot lower, and therefore, if the risk for the dollar yen is a lot lower from here, which by the way I'm not short, that probably will translate that the dollar remains weak, not just against the yen, but probably against other currencies too, namely the euro, the cable, the Aussie, the Kiwi, maybe the Canadian. Will probably see some continued dollar weakness here. So with the dollar yen, you got to be very careful with being on the long side of this. I think being on the short side is the way I'd want to play. I've been hoping for a move back above 109 so I could short it, but it just hasn't developed into that as of yet. But I'm hoping and I'm hopeful that maybe if the equity markets can recover a little bit today, the dollar yen might, recover back to like 108.50 or so, and then I could look for shorts up there. I'm trying to be hopeful that that's going to happen. I just don't know if that's going to be able to, come to fruition today. So with that being said, I want to thank all of you guys and gals that have, joined the ForexAnalytix community, especially over the last few weeks. Really happy that you've found us. And for those of you that are, wanting to try ForexAnalytix, make sure you do so. It's only $1 for 10 days just to try it out. And then also visit our webinar sponsor, which is Forest Park FX. They assist traders like yourself in finding a broker that is best suited your needs. And you could be part of the reimbursement program if you're with one of these brokerage firms here. But even if you're in North America and you're like, well, I can't use any of these brokers here, they could at least help you and assist you in getting some cashback rebates. So make sure you chat with them. Their links on how to get a hold of them are right here on our website. So Steve Stelios,
are those birds singing behind you,
Coach? Do you hear the bird?
Yeah.
Yeah. I have a little bird feeder out front of our out front of my office window here, and they this is the time of year that they're happy before it is 100 degrees outside.
Yeah, and they start getting cooked.
Yeah, exactly. So they're happy. I'm surprised you guys could hear them. So
very clearly, actually. It's nice.
Awesome. Well, so guys, how was your? I know it's Easter Monday there in Greece, and it's Greek Easter. I'm sorry, it's Greek Easter next Sunday.
Yes, that is correct.
Yeah. So you guys don't celebrate Easter Monday. That's the rest of Europe.
I assume. I'm not really religious, so
yeah, me neither. So I don't know.
Yeah.
Well, Easter Monday is observed by a lot of other European countries, and I know since married to a Greek, I understand that being Greek Orthodox, Greek Easter is next Sunday. So, but in other parts of Europe, people are celebrating, and it's a bank holiday, So it's going to be, I think, relatively slow today. I think today's liquidity is going to be pretty illiquid.
Yeah.
I guess.
Yeah, that's how it looks like.
Yeah, and so don't get too excited about the moves that you see here today. It's not, it's very little liquidity, so the market can be pushed one direction or the other fairly easily. So try not to read too far into it, and try not to be too aggressive today. Is I guess the message I'd like to get out.
100% in agreement, Blake. When do you see liquidity coming really back? Tomorrow, or you think it's going to take a couple more days?
Yeah, it would probably be tomorrow in European trade. I mean, you'll see some Asia might get a little bit of liquidity back, but for Asian markets, but really it's going to be European morning, tomorrow morning. You should see liquidity really come back to the market. So, therefore, just be careful. Don't get too excited about what you see, and just, tread carefully, in my opinion.
Indeed.
All right. Well, guys, I hope you have a great session. For those of you that are members of ForexAnalytix, I will be on the daily roundup webinar in about 4.5 hours from now, something like that. 4 hours. Yeah, 4 hours from now. I'll see you guys in 4 hours time.
Thank you, Blake.
All right. Thanks,
Bye-bye, Blake.
guys.
Thank you.
Have a great
See you
one.
later, mate. Bye-bye.
Thanks. Good morning, guys.
Hello,
morning,
guys.
Dale.
Nice,
Good
quiet
morning,
day.
Coach.
Yep. So, not much moving. The main, I guess, the main issue is oil, where Blake mentioned a little bit, where we had an agreement between OPEC and Russia. They're going to cut just under 10 million barrels, but that's I think if I read correctly, that's only going to be valid for 2 months, and then they see how it goes. So this, I was thinking about it, and the market
Clearly, the market was not overwhelmed by that, as
yes,
we can see in
they
price
were
action.
expecting a minimum of 10 million. I think the market got a little bit disappointed. But you know what? I was thinking about this, and I compared it to what the Fed has been doing. And what, if you were OPEC, what would you do? Would you go in and cut 25 million barrels? Of course not. You would take it slow, right? You go like the Fed. Initially, they said, we're going to have 200 billion worth of stimulus. Well, market just laughed at that. Then 1 trillion, 2 trillion, 4 trillion. I think that's what's going to happen with OPEC as well, and they're going to probably ramp it up a little bit. They're going to see the reaction and then gauge that and see how it goes. But the main effect is that this virus has basically brought economies to a standstill. We've talked about this so many days now, and this is not going to return from one day to the next. The good thing with oil is that
Clarida seems to be disagreeing with you, Stelio.
Yeah, I'm not going to comment. No comment, Your Honor. So the good thing with oil is that it has, we've said this again before, it has all these automatic stabilizers. You see, if you've seen Baker Hughes oil rig count in the US, it's gone down from like 800 something to 500 within 2 weeks. So you get a lot of oil wells going idle, and we know how this works. You can't start them up again tomorrow. This is a process. So this is going to happen as more.
And there are costs involved.
Exactly.
I mean, when you stop production, there are costs involved, and then if you want to resume production, there are also costs involved and time required.
Yes, just like our friend Dominic said actually here, he says, I don't see restaurants reopening while their maximum earnings potential has been halved. Basically, restaurants, we're talking about oil, but it counts for pretty much every industry. You're laying off people. You're not going to go hire them back straight away because you know that demand is not going to be back where it was after, let's say, the virus is gone tomorrow. Well, demand is not going to come exactly where it was before. It's not even going to be close. So I think Dominic is very right. And we've been saying this all along. It's going to take a while for things to come back after.
That didn't stop the government from wanting to bail out all of them, though.
Of course.
I mean, the restaurants including.
Yeah.
Which is funny because, for example, since you mentioned the example, the restaurant business is a very risky business. I mean, even in good times.
Yeah, high turnover.
Yes, exactly. And they actually want to try to bail out businesses that, have a high likelihood of going under anyhow. And we see the rotation. I mean, more opening, some of them closing, others opening again, more closing. And obviously, always during a downturn in the economy, since the first type of expense somebody stops is anything that has to do with non-essentials like jiggles and fun. So
food.
I'm looking forward to reopening my restaurant. You know what my specialty is?
What is it?
Jello sandwiches.
Jello.
Jello.
Oh, Jello some.
Jello
Yeah.
Anyway, a friend of mine told me, he grew up poor and his mom would make Jello sandwiches. And then by the time you open the lunchbox, he wasn't really able to trade with anybody. Because, the Jello.
But yeah, I mean, I think you're absolutely right. And like James says, people are going to be afraid to travel, of course, abroad. Of course they're going to be afraid to travel. So there's going to be much less.
I want to get out of here.
So much less tourism, much less consumption. Countries like Greece here, we're going to have a huge hit because tourism is a huge part of our economy. We're lucky that shipping is another big part, which has not really suffered that much yet. But it's
is the key word.
Let me ask you guys this: since the U.S. has really had the worst performance in mitigation and so forth, if an American citizen flew to Athens, I bet most countries would not welcome Americans without a quarantine.
14 days.
Okay, so who's going to take a vacation that they have to be quarantined 14 days
for 14 days
before they start their vacation?
Exactly. That's a valid point.
No one would. I wouldn't. I mean, where do you do it? In your, $300 a night hotel room for 14 days and you can't leave, or an isolation center. Anyway, I don't see how this is going to come back. And as far as countries welcoming highly infected countries, I wouldn't want those people coming into my country unless I knew.
Yeah, it's a very delicate matter, isn't it? And
absolutely,
many countries are doing that. They're putting people in quarantine. But the problem is that even, I've said this before, even if tomorrow there were no cases, no deaths, nothing, what do? Do you go out and you go everywhere? No, I'm not going to do that. And I think I'm not the exception. So,
no, our psyches are damaged now.
Yeah, exactly. So I think the effects on the economy and by association to the stock markets is going to be felt for a while. Now, the issue is, what more can the Fed do to prop up stocks? Are they going to start buying stocks outright, ETFs or whatever? If they do that, then of course stocks will not go down. But
I don't think they will. Of course, if they end up needing to do so, they will, because they've already, they can bypass the law in many, many indirect ways. So, for example, what they're doing...
S&P 1800, maybe they'd come in, huh, Steve?
They're already doing it in essence, because what they're doing is providing liquidity to those that can do it for them, in essence. True. That's what they're doing. And they're bailing out even hedge funds that, will actually do that. So, of course, it might come to the point that they might even need to do it directly. But so far, they've, during the past, 3 weeks, they've released 10 different facilities, 10 different acronym facilities. That's not a joke. It's a real number. 10 of them within almost the equivalent number of days.
Look at the impact. They really had huge impact, more on the corporate debt side, because I'm watching that arena.
What are you
Look at
about?
LQD.
There's no more corporate side. They've nationalized almost every debt market there is out there.
Right. Okay.
That's a few years ago that would sound like a joke, but that's what they've done in essence. The vast majority of the debt markets have now been nationalized because they belong to the Fed. They're not the buyer of last resort. They are the only buyer, and keep that in mind. They will have to keep doing that for eternity until things blow up. I mean, in essence, because these are markets that have real structural problems. And think about it. There is somebody coming in and saying, I'm going to buy all of it from your hands if you want to sell it. What do you think they're doing?
Yeah.
They're selling to the Fed, right? I mean, what would you be doing if you were them? Somebody, imagine, you've made a really, really bad bet in a market.
Yeah,
the market is about to go under and totally implode, and then somebody shows up and says, don't worry, I'm gonna buy as much as you own if you want to sell it to me, and at a good price.
Well, it sure worked on LQD. I will say that which are corporates, junk hasn't done as well. And you know what? To the expense of sovereigns. If you look at the difference between, say, the corporate debt market and the Treasury market, now corporates are actually outperforming treasuries. That's a perversion.
Yeah, and we're talking about it's totally perverse if you consider that we are talking about an economy that, if left to rebalance, the vast majority of high yield debt instruments would just go to zero. So this is the epitome of moral hazard. I mean, the markets have been built to have one function: properly allocate capital to good investments. And we've now managed to, they initially managed to distort that at a big extent, and they've now managed to even somewhat reverse the real function of a market, right?
Yeah.
I mean, it's moral hazard squared, because now you have every reason to want to own the riskiest type of paper than the opposite. Think about it. Let's say I'm not going to go before 2008. Let's say post 2008 and until today. Okay, there were some institutions that wanted to be more prudent. So what did they do? They bought less risky assets to hold. Okay, what was the result of that? Of course, they were producing a lower return, because that's what the market is supposed to do. High risk, high return. Low risk, low return. So imagine, if you were the kind of a fund that wanted to produce a secure return, you produced a low return. If you were the kind of a fund that wanted to produce a high return, you took higher risk. And now it ends up that you were the smart one and the other one was the stupid one, because they had absolutely no reason to not want to take risks, because there is no risk in the market. I mean, no matter what happens, they're going to buy it off your hands, because they don't want anything to go under. They don't want to, they want to bail out everything in advance. So bottom line, we have a market that rewards imprudence and punishes right economic behavior. How do you think this is going to end? No, honestly now, how do you think this is going to end? How many different type of ways that can this end, really?
Well, many bad ways to end.
Yeah, but do you see a good way out of it? Because
no.
Every 10 years we go into that, and we come out of that by throwing, I mean, we're trying to fix leverage and debt issues by upping the ante on leverage and debt. How many times can you do that before everything implodes? We're about to find out. Is it 2? Is the magic number 3? Is it going to be 4? But I really don't see it going past, your ability to count in one hand.
Yeah, either that, or they just let the buying power of currencies just go to nothing.
Which is what's going to happen, because because any government, because let's be honest, whoever doesn't understand that central banks are really a branch of the government, I mean, you just need to pay attention. I mean, nothing else. So the government has, can do 2 ways: take your money through taxation. I'm not going to say honest taxation, because there is a big debate how honest and what part of the taxation is in essence honest, in the sense really needed and should be there, and you should be working to pay it instead of like taking advantage of your labor, or taking away the purchasing power of your money. Of course they will choose the dishonest way, taking away the purchasing power of your money. As simple as that.
That's a way that happens more slowly, and people don't realize it. It's like the boiling frog, right? Anyway.
Yes, I doubt that it's going to be slowly, though, Stelios. I think it was slow. I think that now we've entered the part that this is probably going to accelerate in a way that's going to be fairly noticeable, rather soon.
Yeah. Okay, like Dominic says, they're not ever going to go, okay, let's be responsible this time. That's actually a nice word. I like that, Dom. Okay, Steve, shall we do the
yeah, I have everything ready.
The draw Absolutely. For Thursday.
Yeah. This is the draw for Thursday, and then we're going to have another one tomorrow for today.
Because Friday was a holiday, so we're not going to...
So, random number generator. We had almost... almost 500 legit. There we go, 488.
Wow,
Up.
that's good.
Yeah. So
that's a lot more than the first 2-3 days.
Yeah. So let's go 3 times. So let's go. 402.
Is that the one that wins the Porsche?
It's Mustafa S. Let me write on the other one. 402. Okay.
Yep.
Noted. Next one. 463. Okay. High numbers.
Yeah.
463. Mark P. Let me know. Write it down.
It's your lucky day.
There we go. And last one, 220.
Ziggy. Fix.
That's your average speed on the Greek roads, isn't it, Steve?
220 DCA. Okay.
Well, congratulations, you guys.
200.
Yeah, well done. So we have one more tomorrow. I mean, 3 more people tomorrow, and that's the end of
3 more people tomorrow, and that concludes, the whole process.
Our celebration of 3 years of FACE.
Of 3 years of FACE, yes.
Amazing,
yes.
right? 3 years already, man. It feels like yesterday.
Indeed,
like 30.
It does. It does. It does. Time flies by. Time and quantitative easings fly by.
We're an overnight success in 3 years, guys.
Let's see. Are we going to have more FACE years or quantitative easings? I want to hear bets. We can actually have.
We'll outlast the Fed.
Yeah,
that is likely.
Don't fight the Fed, man.
Yeah, well, I think as long as the Fed is going, we will be too. If they fail, who knows what's going to happen? They close the casino down.
Scott says, keep in mind the Fed still holds 60% of the mortgage-backed securities that failed in 2018. What a surprise. I just, a little while ago, I tweeted, fool me once, shame on you. You know the rest. And I pointed to this. Bernanke in March 2007, housing crisis contained. Then going to Congress saying that the Fed is not monetizing debt and they're going to unwind the debt, immediately after the emergency is over. And guess what? Clarida, for those that don't know, Clarida is the number 2 in the Fed at the moment. Guess what he said today? The number 2 official of the Federal Reserve on Monday said the US economy was fundamentally sound and the central bank would not need to continue its massive support of financial markets indefinitely. I'm very confident that as the economy recovers from this hit and begins to recover that way, at the appropriate time, be able to unwind these programs.
Appropriate? Come on, 50 years later, it's very appropriate.
Yeah, I mean, previous time, the emergency that would be immediately get unwound ended up being already 12 years and counting. Who believes that the Fed was unable to unwind roughly $3.5 trillion from its balance sheet? Because I remind you that when they began, all the stuff they did in 2008, they had a balance sheet of roughly 900 billion. So let's say 1 trillion to make it round, okay? And they went from 1 trillion to 4.5. So they inflated it by 3.5 trillion. They managed from those 3.5 trillion to unwind roughly 800 billion when they were doing quantitative tightening. Now, from unwinding 800 billion from the 3.5 trillion, we now have projections that within the year, they will likely surpass 10 trillion in the balance sheet. Within the year, we don't know when this ends. We can now project roughly how it's going to look within a year. And who knows what after that and, for how long, etc. So who believes that they totally failed to unwind 3.5 trillion, but they will be able to unwind more than 10 trillion?
Yeah, no one, probably.
I want to hope that no one, because you really have to be a fool to believe that. I mean, I understand why some people didn't understand the first time that it was impossible for them to unwind, and the reason somebody could understand from the first time that it was impossible to unwind it was a very simple reason. Once you go in the process, once you open the Pandora's box, it is impossible to close it again, because you in essence build an economy based on this type of intervention. And if you really thought it was undesirable the first time to go through the pain of real economic rebalancing, how are you going to persuade anybody to do it the second time when rebalancing is going to be a lot more painful, or the third time when rebalancing is going to be even more painful? Anyhow, let's go to market questions. Enough said about that. We had the luxury, of course, today because not much has been moving. I'm going to start by the S&P saying that we closed on Friday at a very key confluence of resistances. You can see it here. 2790 was the confluence of the 50% fib and horizontal support resistance area, and we held that. We moved substantially lower, from the open on Sunday, but we've already pared back all the losses. I personally don't see any reason, especially in a day like today where liquidity is thin, where we're going to reverse hard lower. I doubt it. And I still consider it quite likely, that's why I'm still holding my long here, that we might even make it to 28.95 to 29.32. 28.95 is a quality of the first leg higher to a second leg higher. 29.32 is a confluence of the 61.8 of the move lower and this horizontal support resistance area. So for me, this little zone between 28.95 and 29.33 is a nice resistance zone. And if we do make it there, first of all, I'm going to book the rest of my profits. Second of all, I'm going to reverse my position to short. So I'm not only going to close it, but I'm also actually going to reverse it to short, because even if we assume that the Fed completely succeeds in decoupling the real economy to the stock market, because we've explained it again and again since the first days of this move lower, there is absolutely no way to escape recession. Now everybody almost accepts that. We said it since the very 4 or 5 days. And second of all, there is no way that going in a recession, the rebound in the real economy can be immediate just because the coronavirus is going to go away at some point, which we hope it's going to be, the sooner the better, obviously, as soon as possible. So even if we assume that the Fed completely manages to decouple the stock market from the economy, and let's say we have already found a low and we will be moving to new highs, I consider it very, very, very unlikely, but let's assume that they manage to do so. I still believe that from that area of resistances over there, we should see a decent pullback. So even if there is more upside following that, I think that will still be a decent short to medium term trade being short in that area if we do see it. Did you want to say something, Coach?
No, I agree. May not get new lows, although I think there's a shot for it. But
me too. I still believe it's a high probability that we're going to see new lows.
But even the 50% retrace of this recovery from up there is a great trade.
At the very least, I would tell you, retesting that swing high over there at 26.46.
Yeah.
So let's assume that you build yourself a cost average of 2,900. That's 250 handles to the downside. Not bad.
Yeah,
huh?
Not bad.
Yeah. So
especially if you could do it risking 20.
Yeah. So either way, I do like that trade, and I'm really hoping we're going to push those levels so I can actually take it. Now, no real reason for me to go through the rest of the markets. Each of them looks, a little bit different. You're going to see a little bit different resistances. Here's the Dow Jones. Here is the NASDAQ. Here's the IWM, which continues to underperform. You can see clearly. I mean, IWM was one of the indicators that, something was totally off because it had failed to follow to new highs.
Yeah.
Here's the DAX. So I still view this rebound in the DAX as corrective. It's well channeled so far. As you see, there is room for more upside here, but I think, worst case scenario, we're also going to go towards the 61.8 at 11,570 before we fail from there. So bottom line, I'm sticking mostly in analyzing the S&P because it is the global risk barometer. So I think that if the S&P gets rejected from there, you can expect, the same to happen with the rest of the markets.
It's like the United Nations now, Steve. They all have flagpoles, and they're all developing their own national flag. All right, so we had a straight line flagpole, and they're all designing their own national flag, but they're flags. They're all flags.
Yep. I think to overcome panic psyche, we need to accept pandemic as an additional season with pandemic protective outfits like winter snow season outfits. Life by medical scientists can't launch flu vaccine. Then we could expect some health threat for a. Listen, here in Greece, we took measures very, very fast, and we've managed to have one of the best situations out there. Just to give you an idea, we have less than 100 dead so far because we started taking measures when dead people were zero, literally zero. But I have to tell you the following. We need to find a way to balance what type of measures we take with the outcome. And, I'm not saying like, money over human lives. But what I'm trying to say here is that unfortunately, the
poverty kills too.
Yeah, exactly. Exactly. The results of completely shutting down economies are going to cost an immeasurable amount of lives, right? Directly or indirectly. So, there needs to be some kind of a cost-benefit analysis and, do the best thing we can do to maximize human life survivability, of course. There's no question about it. But what I'm trying to say is that it's not necessarily locking down everybody and the economy that's going to maximize, preserving human life, unfortunately.
Yeah, we can't stay in caves the rest of our lives.
Yeah, perhaps we should look into other measures, like mostly isolating people that belong in sensitive groups of the population.
And concentration camps.
Not really, but you know how it is. I mean,
yeah, they'll be like that.
How we all do it now, we can make sure that older people or people with pre-existing conditions, can stay longer in isolation as others are trying to bring the economy back to speed. Because, I mean, how much money can you actually print to get out of trouble? I mean, you can say if you could inevitably, delay, productive functions of the economy just by printing money, then in general, we shouldn't go back to work. I mean, everybody enjoys leisure and free time, right?
Yeah.
So one of the reasons I explain to everybody that don't understand economics why you should be very, very skeptical and very scared of what is happening at the moment is because if printing money was a solution without huge costs and consequences, why do we need to employ it under bad periods of time? I mean, when something is an emergency or whatever. I mean, if it is a measure that actually works and has no side effects we should worry about, why pay taxes?
That's exactly what people are thinking. If the Fed could print $3 trillion
Yeah, why not print?
What they
Why
need?
not
What
print the
they
money
need
of
my
taxes?
30 grand? What they
Yeah.
need my 30 grand for?
Exactly. And trust me, they do need your 30 grand because printing money has huge side effects. Huge side effects. It's not by accident that they haven't done that in the past. It is because they might not admit it, but they know very well and realize what that is going to do. Go back in time and see what happened to the Weimar Republic in the 1920s. See what's happening now in Venezuela. See what happened a few years ago in Zimbabwe. See what happened in many countries post World War II at a lesser or a bigger extent, and you'll find out why.
Look at what Saza is saying, and that's an attitude that a lot of people are going. So what? I mean, all it's doing is taking out people that milk the system for retirement and have passive income. Taking out the vulnerable. They're not paying taxes anymore. So who needs them? I'm telling you,
Exactly.
there's that attitude with
Yeah.
there's resentment between
A-
generations now.
And
The
something,
millennials are saying, "Who needs all these old
they
people?"
they were making fun of AOC and the other proponents of modern monetary theory, and they're doing exactly that now.
Yeah,
And now
that's true.
suddenly
It's
that was a
okay.
joke. It was
Yeah.
a joke, and suddenly it's okay.
Yeah.
So it can't be both, right?
Yeah.
It was either a joke and remains a joke, or it was a legitimate solution and remains a legitimate solution. You can have both.
An act of desperation.
Yeah. Joe says Powell said on Thursday that banks should continue to pay dividends. Of course, why not? Right? Amazing. Taxpayers paying for that. Yeah. Taxpayers paying for that, not with taxes anymore, Joe.
Yeah.
With I told you how. By eroding your purchasing power over time. That's how you will end up paying everything.
They shouldn't. Yeah. So Yellen and Paul are on different pages here.
Who cares? I mean,
anyway.
It's a detail, you know what I mean? They agree on most of the stuff they're doing.
Yeah. Anyway.
Anyhow, a friend here is asking for the FTSE. As you can see here, the FTSE is probably one of the weakest indices, right? You can see it clearly here. I mean, other indices have already surpassed 50% retracement.
She was sexy.
Yeah, totally. Currently testing the 38.2 in a less steep channel, so I would be very careful here with the FTSE. We might find resistance here or a little bit higher towards the channel resistance 600. 6,100, 6,200. I would expect anywhere there to probably end up failing. And you should view this as a corrective rebound until proven otherwise. Okay, having to do with crude, I took a stab being long on Friday, and I was totally wrong on that. So I got stopped, within the same day. I thought that we might get another leg higher. Still, there is a chance of that. You can see there is some type of a channel we're currently holding, but it was outside my risk tolerance. So it doesn't really matter because I believe that if we are to move higher, we're going to move higher before, retesting 23. So, obviously it's more than clear that the measures they announced are not enough to persuade the market that crude should be moving higher from here. Obviously, the market still considers the output cuts that they announced being far inferior to the demand erosion that we're seeing. So I assume that best case scenario for them is if crude oil keeps consolidating near these levels without posting a lower low. Not that I find it unlikely that we're going to post a lower low. Best case scenario, we hold this channel here and we post another high. But so far, this initial reaction is totally underwhelming. So I think they will realize that they will have to do more if they actually want to see crude oil prices rebound from here. Now, having to do with gold and silver, that people ask, keep in mind that on Friday, gold closed to 7-year highs. I know that we've had higher levels in March, but we didn't close there. So the daily and weekly close on Friday was the highest daily close we've seen since 2013, at some point in 2013. And that is definitely a sign you should not be ignoring. Now, there is RSI divergence, as Dale said. There is no disagreement with that. But there is also no disagreement that gold, despite dollar holding up quite nicely, is at the highs. And if we do break above 1703, I think it's just going to keep on moving higher, with 1733 being the next upside target, which is the 78.6% fib extension from the all-time highs to the 1,100 or whatever low we got following that. Now, silver, has broken through the confluence of resistances at 15. Keep in mind that another important confluence of resistances can be found at 16. 50 daily moving average, a 61.8% fib from this move lower, and the horizontal support resistance area. I think that it's not going to be easy for silver to slice through that level as well without seeing some type of a pullback first. So, you need to keep that in mind. I mean, from a risk reward perspective, buying here again 16, probably not the best of ideas. You'll probably get a pullback and an opportunity to buy at better prices. If you have time, can you talk about whether hyperinflation can exist in a deep recession? Of course, it has existed in the past. It seems these two forces are opposed. Yes, these two forces are opposed in the sense that a recession makes demand contract, and contraction of demand is deflationary. Now, I'll say it as follows and you'll understand. Let's assume that you are on a treadmill, okay, and you set the treadmill to X speed, let's say 3 miles per hour, okay. Now, the treadmill is going to be pushing your body back at 3 miles per hour. Now, if you start walking by 3 miles per hour, in essence, you're walking 3 miles per hour relative to the treadmill. You are, standing still relative to the ground. So, you're just doing what you're supposed to be doing. Now, imagine that you put the treadmill at 3 miles per hour, and imagine that 3 miles per hour, the belt of the treadmill is the deflationary forces of a recession. But at the same time, you start trying to run on the treadmill 6 miles per hour. What's going to happen? You will surpass the force of the treadmill that would take you back by 3 miles per hour, and you will actually start running 3 miles per hour relative to the ground forward. So imagine that being inflation and the treadmill's belt being deflationary pressures due to a recession. You can have a lot more inflation under circumstances than the deflationary pressures of a recession. It needs quite some effort to manage it, but they're putting that effort in. Also, as I've said multiple times in the past, they are trying to persuade that deflation is something that should be avoided at all costs. Deflation is something that should be embraced, because deflation is a natural reaction from an economy during a recession that softens the hit to the consumer, to the citizen, of a very bad situation. Because during a recession, the average income goes substantially down. At least the deflationary pressures make sure that the part of the income you still maintain has at least as much purchasing power as it had, perhaps even a little bit more. Now,
imagine. What's interesting, Steve, just one interjection, is that how the past can affect what you fear in the future. Germany had hyperinflation, okay? And what do they fear more? They fear that more. and they may end up deflating. Whereas here in the US, we had a deflationary depression. So that's what we're all afraid of here. So so we're going to go the other way because we've
You
already
never had
tried
a
the other way. Huh?
You didn't really have. You mean about the 30s?
Yeah.
Are you referring to the? Okay,
Yeah.
referring to
Yes.
30s. Okay, sorry.
In the 30s, you had the Weimar Republic.
Yes.
You had hyperinflation. That's the German sphere. In the 30s here, we had deflation, bank failures, everything. That's the U.S. sphere. So they're at the same time in a depression, one nation underwent hyperinflation and another nation went through a deflationary depression. And now that's their memory. So that they'll go the other way this time. Don't you think Germany might choose to deflate?
That's a wise choice. There's nothing wrong with deflation. I've explained that again and again.
They know having a wheelbarrow full of Reichsmark.
And if you think there is something wrong with deflation, I can give you a very recent example. Look at I wasn't referring to you personally. I mean, anybody that listens in.
I'd love to see house prices.
Look at Switzerland. Yeah. Switzerland, in essence, quote unquote, suffers from very low inflation, for a long period of time. Oh my God, what a suffering, right? Who would want to be in the place of poor Swiss people? I mean,
poor gnomes.
Yeah, I mean,
on the bench.
They don't know what they're missing. I mean, they should, they should really do something about their inflation because they're suffering over there. I mean,
anyway, that's a good example. So I think it was a good session, despite it being a holiday in Europe and us not having a speaker. So if you're ready to wrap, Steve, anytime, your call.
Let me go through some of the market questions. I think we talked about a lot about the economy today. Let me see if there are market questions to analyze. Gold, silver, gas. Okay, let's have a look at gas. Here's natural gas. I'm very interested to see what natural gas is going to do here. You can see why, right? Yeah. Backtesting the broken descending channel. So I think this is a key area for natural gas. And I think that from a risk reward perspective, this looks like a rather appealing long from here. I mentioned it, I think, on Friday again, and you can see it here on the chart.
Yeah.
Indian pharma sector up 45% from lows of March. I'm not really familiar with its specifics, so I don't want to. Keep in mind the Fed still holds 60% of the mortgage-backed securities that failed in 2008. Of course they are, and they will forever. That ledger balance is still a lie, starting it worth 0.95 on the dollar. Yeah, of course. So instead of Zimbabwe, Venezuela style hyperinflation, we're going to get something like the TRY did. Most likely, yes. Let me see. Meaning of dotted line in RSI diagram. You can see with dotted lines the 70 and 30 areas. Those are in essence overbought and oversold readings, just as a rule of thumb. I mean, depends on the market. Sometimes 70 is not that overbought. There are people that really start paying attention to RSI signals as overbought and oversold at 80 or at 20 equivalently. So it's a matter of preference. I also, from experience, believe that 70 is not really that overbought, because when you see strong trending markets, they will very, very easily slice through 70 or through 30 if it's a downtrend. Like nobody's business. I mostly use RSI to spot divergences in momentum or very, very extreme overbought and oversold levels. So for example, the very rare occasion that you're going to see a daily RSI above 85 or at 90 or whatever, because these are usually really unsustainable. Your views on Aussie and Kiwi technicals now against US dollar. Can you still see Aussie rising? I think it's not easy for them to go higher for the time being, because I do think that the vast majority of the currencies are going to do very, very well against the dollar in the not so distant future. But to begin with, I think that when we see another leg lower in risk, probably we're also going to get a rejection both in the Aussie USD and the Kiwi USD. So pay close attention. As you see, the Aussie has a very nice confluence of resistances at 64.50, 61.8% fib, and horizontal support resistance area. Already we see that, you know, it's rebounding in a channel. Momentum seems to somewhat be stalling here. And if you see the Kiwi, it's not really that different. So I would assume that they would fail rather soon. Now, will they manage to post a lower low? I'm not that certain about that, but the risk-reward ratio doesn't favor long positions as we speak. I think we need to see a very decent pullback first before that happens. S&P did V recovery as per article in investing.com. I've said it since before we started getting the rebound. I warned in advance that the indices should rebound following the actions of the Fed, and I warned that you shouldn't be fooled by the momentum, because bear market rallies tend to be very strong and very vicious, and they tend to trap bulls in the wrong direction of the market, believing that the market has actually found the bottom. Now, I'm not saying that it is impossible to have found the bottom. I'm saying that it is still very, very likely that we haven't. Okay.
Are you there? Can you guys hear me? I think we lost Steve. Yeah? Okay. All right, well, you can hear me? Okay, Enrico. Well, let's wrap it up, okay?
Dale?
Yes. Yeah, we lost you for a while.
Yeah, that's quite interesting, actually. Something happened with my internet.
I'm going to have to get you a new computer.
Yeah, something happened to the internet. Who knows? Okay,
Anyway.
USD INR to finish up for our friends. Still in a triangle, still looks likely another high before lower. Okay, Dale. So I think we covered most of the stuff here. And
yeah, you did.
More tomorrow, right?
Okay, okay, buddy. Yeah,
tomorrow,
we should have full
probably
session.
We'll have, yeah, exactly.
More
exactly.
liquidity on a turnaround Tuesday. So do your work and get ready, and don't just count your pips, count your blessings. Thank you, everyone. Stay healthy, stay home, and we'll see you tomorrow. Adios, Steve. See you later.
Bye-bye, Dale. Bye-bye, everybody.